Hi there everybody and welcome back to another stock analysis video. It is still Sunday for me. However, DR Horton is actually putting out their earnings on Tuesday and I'm going to be putting this video on Tuesday. So we're going to analyze this company in regards to their fundamentals and see what kind of price we can actually find in regards to the shares outstanding and cash flow. This one was actually recommended by my friend. I better see your comment down there when this video comes out, so help me God, my dude. And hopefully we can come up with a good target share price as to where we should price this company at. Apparently they are the number one or number two home builders of America, and you know how prices are today when it comes to housing. It is very expensive. The demand's really high. So with that said, let's get started with this analysis. We are going to start, of course, with the dividend summary. Dividend yield of 1.26, which actually ends up being 23 cents a share for an annual payout of 90 cents. Payout ratio is only 6.58% in regards to the net income, which is actually really good. Like, I like to buy anything under 60. This is at 6.5, right? 6.6. So this is really solid. Now take a look at this in regards to the cash flow. However, in regards to the income, it's looking very solid. The 5-year growth rate, guys, is wow, 20.11%. That's massive, actually. That's really big. Yeah. So this is exactly what you want to see, a low payout ratio with a high 5-year growth rate, and unfortunately they only have 2 years of dividend growth, but they might be able to continue this depending on how their fundamentals look. Ex-dividend date was February 16th, payout date was February 25th, and they pay their dividends quarterly. Coming over here now to the spreadsheet, ticker symbol of DHI, market cap of $25.7 billion. PE is 5.72, meaning that in accordance to their earnings, this share price at $71.35 might be a pretty good buy at this point. However, let's take a look at other metrics to come up with an even more accurate representation of what this company should be worth. Now, since they pay a 90-cent annual dividends per share, this comes out to be $318.8, less is rounded up to $319 million being paid out in dividends every single year. And in regards to their 5-year average free cash flow, they're still left with $233 million after this dividend is paid. However, looking at the payout ratio in regard to the free cash flow, this is a whopping 57.77%. Still under my threshold of 60%. However, this is not looking as good as the payout ratio that we just saw in Seeking Alpha. So take it with a grain of salt as it is. This is still looking pretty good. However, it's still not as good as it could be, right? Nonetheless, this might be a pretty decent buy. Now let's analyze the fundamentals. Starting off, we got the net income 5 years ago of $1 billion to 1 year ago, guys, of $4.2 billion, increase of 302%. This is looking very good, actually. Like, as you guys can see, this is looking very steady. And I am not surprised in the slightest that 2 years ago to 1 year ago, they pretty much just doubled their net income. We all know how the housing market is right now. It's absolutely insane. People are overbidding their houses, or sorry, people are overbidding their bids, I guess you could say, by several tens of thousands of dollars just to get the house. You know, they're not even looking at the house before, but it's just crazy, right? So this is not surprising. This is a home building company. Prices are going through the roof. Not really surprising. Is this going to continue? I don't necessarily know, but it might come down in the next 4 years. So it really just depends on how the market goes. But so far as we can see it, this is looking really nice. Now let's take a look at the free cash flow, the lifeblood of the company. Cash from operations less your capital expenditures. Honestly, this is looking really good up until the 2 year ago mark, and then it just completely collapsed. 5 years ago of $283 million to 1 year ago of $267 million. That is a decrease of 6% with an average 5-year free cash flow of $552 million. Now, I don't necessarily know what caused this downturn right here. Actually, no, I'm going to take that back. I honestly think the reason why this happened right here is because of prices going up so much when it came to starting up new builds, right? You see a nice steady increase within the past 5, 4, 3, and 2 years ago, and then because of just the housing demand, it was really difficult for anything to happen, so their capital expenditures probably went up a significant amount. Or either their cash from operations actually went down, which is not something that you want to see. Nonetheless, they did go down. Is this going to continue into the future? I don't necessarily know, but for this metric alone, this is a negative sign and definitely something to take a look at into the next coming years, just to make sure that you do not have a negative cash flow in the future. Looking now at the revenue, we got 5 years ago of $14.1 billion to 1 year ago of $27.8 billion, increase of 97.11%. Really good looking graph, guys. This is awesome. This is actually looking really solid. Every single year is a nice steady increase before the other one is absolutely amazing. Exactly what you want to see. So far right now, we got out of the 3 profit metrics, only one of them is bad, and honestly, it may have just been because of the fact that the housing market is just in so much high demand. Now looking at the total assets minus the total liabilities. If the company were to liquidate all of their assets, would they be able to cover their liabilities, and by how much? Currently, if they were to do so, they would still have a whopping $20 billion left, which is amazing. And not only that, they were able to do this every single year within the past 5 years, and not only that, but they have also increased it as well, which is really good. Average total assets around $17.3 billion, average total liabilities around $3.3 billion, average assets minus the average liabilities, we got around $14.1 billion. Looking now at the silent killer when it comes to investing, the shares outstanding. This one tells you whether or not the company is diluting you as the investor. As you can see right here, they're doing a pretty nice job. 5 years ago of 375 million shares to today of 354.3 million shares. On the 5 year, that is a decrease of a little bit more than 5.5%. From the previous year to the current year, we're looking at 2 years ago to 1 year ago, it is a decrease of almost 0.5%, which is really good. They are not diluting you, and in fact, they're increasing your ownership as a shareholder. And lastly, taking a look at the cash equivalents, currently they have around $2.4 billion in cash equivalents with an average cash of around $2.1 billion. Now time to make some assumptions. Low, median, high, as always, 3 different factors: growth, share buyback, and required rate of return. For the growth, guys, I like to use Seeking Alpha's growth tab. We see the revenue growth year over year and the revenue growth forward, and come up with a conservative metric between those 2 numbers. For the predicted share buyback, I like to see the shares outstanding graph that we just saw. And for the required rate of return, keep it flat, 10% to match the S&P 500. Now, for my lowest assumption, let's assume a growth of 18%, predicted share buyback of 2%. This comes out to be $57.73. For my immediate assumption, let's assume a growth of 21%, predicted share buyback of 3%. This is $64.01. And for my highest assumption, a growth of 24%, predicted share buyback of 4%. This comes out to be $70.84. Now adjusting for debt, the way we do this is we take the cash equivalents and we add the net debt. If they have more debt than cash, this number comes down. If they have more cash than debt, this number comes up. So you can see right here, this number does come down a little bit to $56.04 for my lowest assumption. For my median assumption, it is $62.31. And for my highest assumption, it is $69.12. Now I think margin of safety of 5, 10, and 15%. For my low assumption, I personally would like to buy this at $47.64 to $53.24. For my median assumption, I would like to buy close to $53 all the way up to $59.19. And for my highest assumption, I would like to buy at $58.75 to $65.66. Guys, the current share price is $71.35. So we are really close to this number, assuming my highest assumptions, especially if you take the target share price not adjusting for debt. So it really just depends as to what you want here. Are you willing to pay this premium for a company like this? They do have really solid metrics, don't get me wrong. The only one that's kind of iffy is the cash flow. But then again, that could easily be explained due to the whole housing crisis that's currently going on. So if you do not believe my assumptions, which by the way include all of them, including the required rate of return, you can absolutely change them. I have this calculator available for anybody to use. It's in my calculator playlist. There's a bunch of videos there, how to get it, how to use it. You go down there in the comments, you open up the spreadsheet, you come up here to file, and you make a copy, and you make your own assumptions. Simply put, if you were to just change the revenue growth, for example, from a high assumption for 30, and you think that they're going to buy 10% of their shares back, and you want a required rate of return of like 15, right? Then you could pretty much see how much this would actually change by, right? Now, if you want a lower required rate of return, this would actually increase it by a significant amount, right? Because the more you pay for something today, the less returns you're going to get in the future. Therefore, changing these metrics, guys, changes a lot. This is why I never tell you guys what to buy. I'm just showing you the raw numbers and my opinions, my assumptions. This is not financial advice. All I'm asking for in return for these 2 calculators, this one and the book value one, and a dividend tracking sheet, is like, subscribe, comment. It really does help. Thank you so much for everybody who has subscribed. 529, I believe, as of me recording this video. Thank you so much for subscribing. If you have anybody in your family or friends that may want to start investing through a fundamentals basis, please hit them up with my channel. That'd be awesome. It'd help me grow. It's really all I want in this world. So thank you very much, and let's actually continue with this analysis. Now, looking at the dividends at the current price, let's take this companies and see if we were to invest in it, how much money will we get out of them in the form of a dividend. Taking the US average income of $68,703, bring it to the monthly, we get $5,725. If we were to put in 1 month's income into this company at the current annual dividends per share at 90 cents, how much of this company's dividends would we get in return? Well, this would actually buy us 80.24 shares, which would be $72.22 annually, $18.05 quarterly, and $6.02 monthly. So, as you guys can see, this is not that good when it comes to a dividend play. For $5,725, you're only getting $6 a month. That to me seems a little bit bad in my personal opinion. There are better companies out there that pay significantly more, maybe like a REIT or maybe another home developer that may be significantly better. All in all, when it comes to DHI, they do have a lot of good stuff. Honestly, they do have a lot of good stuff. And even though my numbers pretty much just say that this is a little bit overpriced right now, just by a smidge, honestly, it just depends up to you as to where you would put this company at, depending on your assumptions, right? And also, are you willing to pay that premium? If you are, then by all means, this is looking really, really good. The one thing that worries me though is that cash flow. Aside from that, everything else looks really, really solid. That pretty much does it for this video. Like if you like, comment, subscribe. As I said before, it really does help. I really appreciate everybody that does that. You guys can follow me on my new tech sites of BitChute, Odyssey, and Rumble. The links are in the description below. I also have a Let's Play channel, link in the description below as well. Currently playing through Sonic Unleashed, so if you want to follow me there, you can follow me there. With that said, peace out, and I will see you all in the next stock analysis video.